All right, let's talk about something that feels like it's from another world, but actually shapes ours every single day. We're going to pull back the curtain on venture capital, the high stakes financial engine that takes ideas dreamed up in a garage and turns them into global giants. You ever just look at a huge tech company and wonder, how did that happen? I mean, really, how does a simple idea, maybe one sketched out on a napkin, actually blow up into a billion-dollar company that changes the way we all live? What's the secret sauce? Well, a huge piece of that puzzle is something you've probably heard thrown around, but maybe never had totally broken down for you: venture capital. And the best way to think about it is as the high-octane fuel for the world's most ambitious ideas. Because really, it boils down to this. Every single groundbreaking startup has two things in common. One, a brilliant, maybe even world-changing idea. And two, a really big, really common problem. They have absolutely zero cash to make it happen. So let's stick with an analogy here, because it really works. Picture a startup as a brand new rocket ship. The team is ready, the destination is Mars, but you can't get that thing off the ground without fuel. Venture capital? That is the special high-octane rocket fuel that powers the entire mission. Now, it's super important to get that VC is private money. This isn't a bank loan you can just apply for. These are investors specifically looking for startups with massive long-term growth potential. They're not funding the next local coffee shop. They're trying to fund the next moonshot. But here's the thing. That rocket fuel doesn't just get dumped into the tank all at once. Nope, it's delivered in these carefully timed stages as the mission gets further along. People call this the funding ladder, and it's basically how a startup levels up, step by step. And look, this isn't a gift. For these investors, it's a huge bet. In exchange for all that cash, founders are giving them something incredibly valuable: equity. Equity is just a fancy word for a piece of the company. So the more cash an investor puts in, the bigger their slice of the ownership pie, and the bigger their potential payday if things go right. This journey almost always kicks off with what's called a seed round. That's the initial spark of cash, just enough to prove the idea can actually work. Then comes Series A, where they use the money to build the company's core engine. After that, Series B is like strapping on powerful boosters to really start growing fast. And Series C and beyond, well, that's the rocket ship reaching for orbit, expanding across the globe and becoming a major player. And you can see this trade-off happening right here between risk and reward. Way back in that early seed stage, the risk for an investor is just astronomically high, right? So the investment is smaller. But by the time a company gets to Series C, it is a proven track record. The risk is way lower, so investors are willing to pour in massive amounts of cash, but for a smaller piece of what is now a much, much more valuable company. Okay, so this brings up a huge question. If you have a brand new startup with no profit, maybe not even a finished product, how on earth do you decide what it's worth? This is where we get into the really fascinating mix of art and science that's known as valuation. And you might think this involves some crazy, complex spreadsheet that no one can understand. But the core idea is actually simpler than you'd think. When you're valuing a startup, you're not just looking at its bank account today. You're making a calculated bet on what it could be worth 5, maybe 10 years down the road. So yeah, valuation isn't about what a startup is worth now. It's really an educated guess on its future potential. Investors are betting on the size of the market, the power of the idea, and honestly, above all else, they are betting on the team. And here is the basic math they use in Silicon Valley every single day. Let's say a company is valued at $8 million before any new money comes in. That's called its pre-money valuation. Okay, then investors come in and inject $2 million. You just add those together to get the post-money valuation, which is now $10 million. So that $2 million investment divided by the new $10 million value means the investor just bought 20% of the company. Simple as that. So let's fast forward. The money is in, the rocket has taken off, the company is a huge success. So now what? How do the investors and the founders finally get a return on all that risk and all that hard work? This brings us to the final and most critical stage of all, the exit. This quote right here perfectly captures the whole mindset. VCs are not looking for small, steady profits year after year. Their entire business model is built on finding the next Google, the next Facebook. They're swinging for the fences every single time, hoping for that one massive home run exit that'll pay for all their other failed bets, and then some. And there are really two main paths to get to that summit. The first is the one you always hear about in the news, the IPO, when a company goes public on the stock market. But the other path, an acquisition, is actually way, way more common. And there's a good reason for that. IPOs are incredibly expensive, they take forever, and they expose a company to insane public pressure. An acquisition by a bigger company, on the other hand, is often a faster, cleaner, more certain payday for everybody.
Okay, so we've covered the whole journey, right? From a simple idea all the way to a massive exit. But let's zoom out for a second. Why does this system, which really only involves a small number of people and companies, actually matter to the rest of us? Let's take a look at the view from the top.
At the end of the day, this entire ecosystem is one of the primary engines of our modern economy. It's what fuels rapid technological innovation. It creates brand new industries out of thin air, and it powers so many of the tech giants that we use literally every single day. Simply put, venture capital is the machine that turns the most ambitious ideas into reality. And just to give you a sense of the sheer scale we're talking about here, investors pump over $200 billion into startups around the world every single year. It's a massive economic force that is actively building the world of tomorrow right now. And that kind of leaves us with this final thought. With all its huge successes and, let's be honest, all its failures, is venture capital the ultimate engine of innovation? Is it the high-risk system we absolutely need to solve the world's biggest problems? Or, when you strip it all away, is it really just a high-stakes casino for a select few? Something to think about. Thanks for watching.